the injury I've had to my leg. So hello again, Propenomix people, and welcome to another Sunday Supplement Live. I'm a couple of podcasts behind. When I get some time, if that ever happens, I'll try and catch up. For those who don't know, I've been off my feet for the moment because I've got an injury to my right knee, which is currently being diagnosed, which has slowed me down a little bit, apart from anything else. So been managing to keep up with the written versions of the supplements. I'm afraid those who much prefer the video or the audio content that goes on the podcast platforms, for the moment, you'll just have to bear with me, and I'll hopefully catch up with them at some point, or dare I say, you'll have to read the supplement or feed it into one of those clever text to voice things that you can get these days. Have a Google of them if you don't already use one. I know a lot of people used to do that before I did the YouTube or the live videos anyway. But anyway, welcome. This was the last supplement for April, and it was called Mind the Gap. Very deliberate messaging because, apart from anything else, as in one of those headlines that tends to just go under the radar for whatever reason, we realised we had a gap of about £15 billion between the sort of tax we thought we should have collected and the spending we thought we should have done in the fiscal year to 31st of March 25. Now, these huge numbers are not really that meaningful anymore, you would think, but we do need to bear in mind that there was a forecast by the OBR that was published on the 26th of March, and we're talking about a 15 billion gap having appeared, if you want to sensationalise it, in the last 5 days of March. It's not really true because that forecast wouldn't have been written and the ink dried on the 26th. It would have been delivered to the Chancellor a couple of months before that in reality, but still, a couple of months, couple of days, being out to the tune of 15 billion is not great. And of course, like everything at the moment, it's going the wrong way. And I'd noticed month on month that we kept on borrowing more than all the forecasts said we would be borrowing. And it's happening again and again and again. And I was asking myself some questions about that. So part of the meat of this supplement is about why is that happening? I want to give also my view on some of the broader brush views that are being propagated by the usual podcast clickbait crowd that I have, a relative amount of disdain for, if I'm honest with you, but all of them have about 50 times the subscribers that I do, so I'm probably the one making the mistake, not them. But I'd rather try and tell the truth and also explain it in a meaningful fashion rather than try and sensationalize things to get clicks, and I can promise you that will always be the way that Propenomix works. So anyway, I like to start with a quote, and this week's was "Mind the gap. It's the distance between life as you dream it and as it is." And that's from Kate Blanchett, the actor-producer. So the deep dive is going to say a bit more about the gap this week, as I've already introduced there. I'm also wanting to say a thank you to those who read and or listen to the supplement, who send me items, videos, podcasts and the likes that they think might be of interest to me. A recent one, which has also combated the rise of the very popular perma-bear economist Gary Stevenson, self-proclaimed greatest trader in the world or whatever, is the YouTube channel of Sasha Yanshin, who does have a tendency, just like the whole game on YouTube, to fluff up his video titles more than a little bit to get some clicks. But I would say his content is well worth watching if you're interested in economics, because very much unlike Gary, he actually gets right into the detail of what's actually going on at the moment. And he's been furiously calling out the Labour Party for many months in terms of what they've been doing economically. So I'm not going to dwell too much on how smart or not it is to increase the cost of employing people, as has happened in the UK in April, because I think by now everyone knows where I sit on that issue, and there isn't really any counter argument. The counter argument I have heard from the left side of the equation is that businesses just moan, they'll find the money, they'll suck it up, they'll swallow it. The reality is we'll see in the economy what businesses can handle it. I think what Labour possibly don't understand or haven't appreciated about business is there might be low margin businesses like Poundland might be a good example of that, or a supermarket, for example, who employ lots of people, or they did employ lots of people. Whether they'll go more and more towards employing fewer and fewer people, this sort of rise in national insurance and the change in the thresholds, it increases the attractiveness of shelf stacking robots. It increases the attractiveness of remote tills and all the rest of it. That's already been rife anyway. So the supermarkets are in the direction of travel coming for many years, but they're not high margin businesses. Whereas a tech company, for example, would be completely opposite, or an education company, huge margin, can suck up the costs and doesn't need to moan too much about it. So what I want to do in the deep dive this week is get into the gap between forecast and reality, and how terrible these forecasts really continue to be, even when we get very, very near to the end of a forecast period, which frustrates me like nothing on earth. But I want to talk about some trends that I've spotted that aren't being talked about in the wider media, as usual, on a monthly basis. And then, of course, I want to include the possible consequences, so the so what, because all of this theory is wonderful, great fun, bit of navel gazing, but it's no good if we don't do the so what. So before I steam into all of that, I just wanted to let everybody know that Rod Turner and myself are running another workshop in July. It'll be on Thursday the 3rd. It's about joint ventures and mergers and acquisitions this time around. So for those who don't know, I have done 8 figures worth of joint ventures, and I don't mean just 10 million. I mean a very healthy 8 figures worth of JVs, and a dozen or so mergers and acquisitions and disposals as well of limited companies of different kinds. So that's my CV for being qualified to talk in this area. It's always a popular subject. I'll give you a quick whistle-stop tour of the agenda. So we'll be talking about the market dynamics at the moment, JV opportunities, optimal legal structuring for property businesses, which is important, of course, learning pros and cons of limited companies, share classes, shareholder agreements, and sustainable joint venture models. We'll dive into capital structuring, comparing debt to equity, managing risk, and understanding personal guarantees. We'll give some insight into property-specific M&A, of course, from due diligence all the way to buying the assets versus buying the shares in a company. We'll apply the concepts through 2 in-depth case studies, one of which is acquiring an asset-backed property company and navigating a distressed business sale as well. So understand strategic disposals, company wind-ups, and how to negotiate under pressure whilst maximising value. So super early bird tickets are available because we're still a couple of months away, but they're online. They're already selling like hotcakes or hot cross buns, if you like. And the link is bit.ly/PBW7 SEVEN. It's also in the description to this video if you want to check the page out. So we had our second half of the Easter short week last week, and it was more calm really because we're still in the early part of the 90-day tariff back off, or whatever you want to call this period at the moment. So Mr. Trump spent the week mostly dressing badly at the Pope's funeral and talking Vladimir Putin down after he seems to have finally worked out his old mate might not be that keen to end the Ukraine war after all, unless the terms are frankly insane in favour of Mother Russia. In between, Mr. Trump also telling some lies about the price of eggs, but nothing really to see and nothing contributing further to a global meltdown that he lit the blue touch paper on back at the beginning of April. But back on home turf, we've had our first peek at the real consequences of the October budget, and I'll get into that as we get into the macro and also the deep dive. Now, what I would frame this current period as more and more is lost time, which is time that in today's society very few are willing to lose. But straight into the real-time market, as I always do, thanks to Mr. Christopher Watkins' efforts for the week, and thanks to Chris for the private messages he sends me on top of what he also publishes on Property Industry Eye and on his YouTube channel. Chris, I am grateful if you come to watch this video, so thank you. What's the question we always want to know the answer to? What's currently happening in the UK property market? So we're reporting on week 15 of 2025 because we run 1 week behind, but it's pretty close to real time, especially compared to government statistics and various portals data. Listings are pressing forward. 2025 is still the biggest start to a year for listings since 2015. It's the earliest time to pass 550,000 listings in the past decade. We're now 8% ahead of the year-to-date listings in 2024, which, remember, was a year of plenty of listings as well, and 9% year-to-date ahead of the pre-pandemic market. So we've kind of settled down now. The averages, the date the year started on, first working day and all the rest of it, all of that average. Easter has also evened out now as well. So we need to bear that in mind. I think we've got 1 more week of short week for Easter. So, Bank Holiday Monday will be absorbed, but then the calendar normalizes because obviously Easter is that movable feast throughout the year. And we're 4 months in, we're a third of the way through the year. So we've pretty much seen stabilization of one-off events, if you like. 10% more stock than normal. That would be the phrase I would have in your head when you're thinking about what's going on in terms of availability on the market at the moment. But please don't ever forget how much stuff on the market is at a silly price or at a waste of time. Around about half of it at any one time. And I say half because around about half doesn't transact every year. Ridiculous when you think about it, but that's the way that the corporate estate agents run their businesses, and that's the way that unfortunately therefore the market is dictated to, because they have such a huge presence. They are responsible for about half the stock on the market at any one time. Things are changing a little bit with the rise of things like EXP UK and the self-employed model. Obviously that's been up and down. Keller Williams were doing that. It's disruptive. It's not yet really gripping the market. I do think, as many of the other commentators do, that it will start to really change the market in the future. But at the moment, it's still just a bit of a mosquito bite for the corporates. But things are changing, I think, and you'll see corporates with self-employed models sooner rather than later, in my opinion. Although sometimes those juggernauts take time, so maybe it'll take them a few more years. But it'll start happening, or they'll be acquiring them, or however it works. So reductions, 13.4% of stock reduced. The 2024 average was 12%, 12.1. That had more stock than we were normally used to, as well, as I already said. The 5-year average is 10.6% for reductions. So we're well above, we're 30% above the 5-year average, really. So more stock means more reductions. That kind of makes sense. But remember, that's in percentage terms, but also it'll be even more reductions if we count the number of reductions. So we had a week with 20,000 plus price reductions around the country. In a bull market like we had in 2021, 2022, those numbers were 11,909 reductions and 8,374. So being over 20,000, we've got more than twice as many reductions. In a normal market, they weren't a lot higher than that, actually. 2017-18, we had 11,584 in the equivalent week and 13,767. So 20,000 plus reductions is significant. And it helps those, obviously, who are out there shopping for deals, as I assume many of you are one watching this video. So sales are pressing on, so the market's not too weak on the demand side. 24,500 went sold subject to contract. Not bad, bearing in mind Good Friday was part of the week in question. 13% better than the 2024 year to date and 20% better than the pre-pandemic market. So 10% more stock, but we're achieving plenty more sales. Very, very healthy stuff by the looks of it. Plenty of business being done. Doesn't sound like it's been slowed down too much by the stamp duty changes. In many ways, the stamp duty changes were a little bit minor and didn't have anywhere near the impact of the stamp duty changes that have had in the past, which we could have known if we looked at the incidence of them. A couple of percent. Don't mean to sound too blasé, but the bigger shock, certainly to the investment community, was October last year. The difference between 125 and 250 is another pain, but it's not as much as the difference between 3% and 5% being added to the whole of the price. Let's face it, because it still gets added to the marginal price, remember. So things have come back a little bit, as I said, because of where Easter is, but that just normalises things compared to a usual year now, so that's all good. I always like to give Chris a weekly shout out because he's much more prolific than just his epic video. His 1-hour video releases on the UK property market every week. He comes up with fantastic stats on a regular basis. So I would encourage you to give Chris a like, a subscribe, leave him a nice comment, all the rest of it, and some kind words for his content creation. And if you happen to be in the property industry and you want support in growing your business, or to be a more effective communicator, be more in touch with your local market, because that's his core business, give him a shout. The article's on Property Industry Eye, as I said, and the video is on his YouTube channel at Christopher Watkin. So, macro time then, folks, and it was some week because we had the flash PMIs, and I'd encourage you to buckle up. Confidence week, so the week of the month where all the confidence stats get released, and some things we need to be aware of there and to discuss. I've also got to squeeze in the ONS private rents and house prices because we didn't get a chance last week to do that. And of course, we have to leave space for the gilts and the swaps. So you won't be surprised to hear about the very miserable PMI headlines. The sharpest fall in new export orders since May 2020. What could have caused disruption with exports, I wonder? Well, but the report is talking about a renewed downturn on top of the more recent downturn, which looks like it just about turned around on March's numbers, frustratingly enough. But we're looking at 2+ year lows across all of the flash PMI numbers. Manufacturing printed 44 Bear in mind 50 is no growth, so 44 is considerably negative. Services printed 48.9. That's the first services print under 50 for 27 months. So that puts it into context. Early 2023, we're going back to when things were pretty miserable and gilt yields were still on the rise. Things weren't good. We were in repair from the lettuce, from the trust situation and everything else. Now, 48.9 is recessionary territory, folks. There's no two ways about it. But we knew April would be bad, and that was before Liberation Day. So optimism, according to S&P, is at its lowest since October 2022. I've already mentioned the salad item that was in charge at number 10 at the time. At least that was at the start of October 2022. So this is the sort of situation I bang on about periodically. When we're already fragile, a knock like Liberation Day and the tariffs hurts a lot more. So this data was collected during and after Tariff Gate, not that that's all over yet, but where the headlines were being absolutely dominated by the next financial crisis and blah, blah, blah. So they don't sound unreasonably bearish because apart from anything else, they'd had some of the good news, if you want to call it that. But we're still speculating about trade deals, aren't we? There's certainly a lot of puffery between the US and China about, is there a deal? Is there not a deal? US says they're close to a deal. China says they're not even negotiating a deal. Who knows? And that does have a knock-on effect on the rest of the world, of course, which I'll get into later on. But this sentence from the report I thought was worth repeating, but it didn't surprise me at all. Anecdotal evidence suggested that US tariff uncertainty and general concerns about the economic outlook had encouraged a wait-and-see approach to major spending decisions among clients. Of course it did, because if you ran a major company right now, could you justify an investment of tens or hundreds of millions or even billions? No, you'd wait and see. Unless the volatility would benefit you, of course, or you see a fantastic deal that's going to work in all environments, but that's not going to cover many outcomes compared to a typical company who is going on, knowing their business, doing what they're doing, knowing that they're going to get a certain amount of traction, but they don't like uncertainty. So that's where they are. They're waiting, right? And in the background, we know these higher national insurance prices kicking in, meaning underlying inflation took a big spike upwards. It's not a surprise. We knew it had to happen. The PMI print is congruent with a drop in quarterly GDP of 0.3%, according to S&P's chief business economist. Now, I always say, don't get carried away with 1 month. We knew April was going to be bad. We've got to see May's print. We've got to see June's print before we start worrying about anything like recessionary territory. What will the bounce back look like? I hope May will be better, not worse. Doesn't always work like that with the PMIs. So we'll see. But we've also got this 90-day hiatus, haven't we, for Mr. Trump? So May and June might be okay. They might just be limbo. I'd suspect they'll be limbo. They'll look like the month before the budget in 2024 to an extent, particularly for manufacturing. Services, not so much, although services is such a broad term. Some services are impacted by the tariffs, but many aren't. So let's see what happens. Now, the chief business economist for S&P described the job cutting as aggressive in April and optimism at one of the lowest levels ever recorded by the survey. So lower than after the surprise result of the Brexit referendum in 2016. Confidence is lower than it was after June 16. Remember how much of a surprise it was to the city, apart from the big wigs in the economy, aside from anything else. Now, the kicker to all of this is it adds pressure on the Bank of England to put rates down. Now, I do agree with that analysis, but the gilt markets haven't exactly played ball yet on that front, not straightforwardly. There's still a lot of vigilantes, bond vigilantes, pushing the yields up and the prices down, not the other way, particularly on the longer dated stuff, which we don't concern ourselves with too much, although I do keep a keen eye on it, as you can imagine. But some dovish chat from the main operators, right, rather than a refusal to comply, which is their default position, would change everything. Now, remember that Jay Powell, who's the chairman of the Federal Reserve, Donald Trump's talked about sacking him, but he isn't going to do it because the market started panicking because, again, that would be a very unusual move. He's up for replacement next year, so it's kind of impossible not to see a Trump loyalist in there next year. But, Trump's impatient and he doesn't have that much time left one way or another on the planet or in the presidency, although we hear these crazy plans about maybe Vance will stand and Trump will be the vice president, and there's nothing stopping him from doing that. But I mean, I'm not sure that the American people will be too happy about complete circumvention of democracy, although they're currently reasonably happy that Elon Musk seems to be paying for votes, whether that works or not, in various elections. And Trump is talking about courts and not really respecting what courts' decisions make, which is a cornerstone of democracy. So there is a concern around all that. Probably not one to throw the baby out with the bathwater, but I think it does need noting because it is considerable. But anyway, the fear that just by temporarily shocking the economy in the pursuit of the new way that will be better, I'm referring to the tariffs here, this is the theory, and not a theory held by all, I should be keen to point out. Rates go down short term, but up and up long term. So it's not an exact science. And so far, Trump has actually seemed to cow down to the bond markets, but he is bullish enough not to, let's face it. And would we see a Liz Truss-style deposing of Trump? I'm not sure that we would. I mean, impeachment is the only way. So it need a lot of Republicans to turn their loyalty. But politics is like that. You're the man or the woman until you're not. Happened to Thatcher, happened to Johnson. It's happened to everybody over the years, right? So can we justify a cut or two in the base rate because of the national insurance shock? It's a shock, so it's exactly that. It's a one-off piece of inflation that won't repeat itself next year. Yep. That could be looked through. Remember, the policymakers look at the interest rate in 3 years' time. So that would be fine, right? So this time around, the inflation that's linked to this national insurance shock really is transitory for a change, right? A cut a week on Thursday, so a week today, as I'm recording this, looks long odds on. Financial markets had it in at 100%, according to Sky News, which is a ridiculous price, and they wouldn't have had it in at 100%. But look, it's more than 80% likely that we see a cut. I'm pretty sure it's 0.25. That's where my money would be going. Although I think a vote or two for 0.5% cut is likely to be on the table as well. And that will be the thing to watch. The number of votes for a 0.5% cut will tell us just how dovish a number of members of the committee are at the moment. They will be worried about these economic metrics that are coming out with. They are worried about stagflation. They have to be. They have to be, because that is largely treacle. I've been describing it as for some time, because I don't like the word stagflation, because apart from anything else, generally it's meant high unemployment. And not by any metrics do we have high unemployment at the moment. But we are in treacle, no growth, lower GDP per capita. Not good, right? Not good. Now, I'm still unwilling to change too many of my predictions for the whole of 2025 so far, because there's still so much that depends on where the UK ends up, absolutely and relatively, compared to the rest of the world, when the tariff situation smoke starts to clear up a little, and we learn what's really and actually going to happen, rather than this sort of flame war that we've been caught up in, right? So on to confidence then. This is the week of the month where all the major figures come out. The S&P said 3-month low for consumer confidence, right? But labour market sentiment actually hit a 4-month high. So that suggests that April hasn't been anywhere near as bad as expectations were, as far as the labour market sees it. And I think that's a really good sign. Not that I'm clutching at straws here, but that was one of the positives in the reports for this month. So we thought April would be really bad. We actually lost quite a few in March. Very well organised businesses were already getting rid of people before the rise came in, as you can imagine. Some less well organised businesses will see the NI contributions this month and go, blimey, I need to do something, but they haven't had chance to do it all yet. Remember how many businesses in the UK are really quite small and employ under 10 people. So we can't expect them always to be completely strategic masterminds, but they do provide a lot of employment. So how they react in April will be key for us to watch. But it doesn't look like terrible news at the moment as far as April goes. Spending curbed rapidly was a sentence from the report. So they mean consumer spending there. But debt sentiment is at an 8-month low. So these data were collected between the 10th and the 14th of April. So we do need to be on top of the windows of when. So remember what's happening there. We'd had tariff gate. We'd had the back off by then. So we hadn't really had time to process it necessarily as people. There would have been fear. There'd have been a lot of stuff in the headlines about all of this. So we don't know exactly where we would be on that front. But we do need to be a bit cautious of these little snapshot windows. GfK's Consumer Confidence Index, which I like quite a lot, dropped by 4 points, not outside of anybody's expectations, with an 8-point drop in consumer confidence over the economy for the next 12 months. All looks very bearish, a bit worse, fair bit worse than 12 months ago, and indeed for the last few months as well. Minus 37 on the confidence of the macro situation, over the next 12 months is 16 points lower than 1 year ago. The only thing that's up is the savings index, although the major purchases index is 6 points higher than it was 12 months ago. So ridiculous, really, when you think about it. CBI's business optimism index among their industrial trend survey was not as miserable as last time out, nor was it as miserable as the forecasts, but it all reads pretty similarly. Lower job headcounts, less investments, costs upwards. More of the same, I'm afraid, and I'm sure that will be annoyingly accurate. So a tiny glimmer of light, but nothing we wouldn't have expected after such a roller coaster month. In fact, I'm tempted to conclude that once again, the economy shows just how robust it truly is in these situations. The excrement really does look somewhere near the fan, but we keep calm and carry on, of which I'm a big fan, of course, not that sort of fan. So, rents and house prices from the ONS. It was skipped last week because all of the big boy macro I needed to squeeze in, but it's too relevant for me to leave it out of the report 2 weeks in a row. So, rents up 7.7% on the year, according to the ONS. Another quick reminder that the ONS figures are a big sample size. They use a company called Dataloft, 550,000 rents, existing and new rents. So this inflation at the moment and for months and months and months has not been coming from the new rents. They've calmed down quite a lot. It's been coming from the existing rents being uplifted to get somewhere near the market rents. The last figure I saw estimated by the ONS or the Bank of England, I can't remember which, was about a 13% discount on an existing tenancy versus a new tenancy. So it's a big old discount for existings, but we don't have those figures over the years, unfortunately. I'd love to know them and see them, to be honest. If anyone knows where they are, please feel free to educate me. That broke back into England up 7.8, Wales 8.9, Scotland 5.7. So get your head around this. Scotland has removed its rent caps and its rents are going up less than everywhere else in the UK and less than they have been in Scotland for years. Go figure. Incredible, isn't it? But the most affordable place in the UK, aka Wales, by far the most affordable in terms of rents per month versus salaries and all the rest of it, is showing the most growth. The ONS has average house prices up 5.4% in the year to February 2025. That's the first time we've breached the 5% number for some time. But yields are moving upwards still, but they're moving upwards more slowly than they have done since early 2023. And there's now a great link in the ONS report. I'd encourage you to take a look. For local area reports, including average house prices, rents, and first-time buyer versus mortgage buyer properties too. So on the ONS website, it's in the written version of the supplement, which is on my LinkedIn or available via the Partners in Property website. You can go and look at prices in your area. Really cool interactive tool for you to have a bit of a play with, right? The North and South pyramid continues to dominate in house pricing terms. So when it comes to prices, the top regions are the Northwest and the Northeast. Now they're up 8% and 7.9% accordingly on house prices. That's absolute crack up boom territory, folks. The Midlands and Yorkshire are remaining above the England average, and it's really the Southeast, the Southwest, the East, and London. And London's at the bottom at 1.7% price increases, and that's keeping that average price increase in check. Don't underestimate at the moment how much we really have a two-tier market that basically looks like under 250 grand, above 250 grand. Of course, there isn't this event horizon point at 250k, right? But affordable stuff is selling. Affordable stuff is the only stuff that investors can buy. So you can understand why the investment money would still be fueling that market, right? And also understand investors can be buying, but still there can be net fewer rental units, which has certainly been the case for some of the last 2 years. We'll only find out when we have detailed figures, which take years to publish apart from anything else. But we all know it hasn't been keeping pace with demand. Whether it's actually going backwards and how long it was going backwards for, we don't know. But you can still have mass disposals in the south. And let's face it, at a really simple level, if you sell a flat in London for 600 grand, you can buy 3 houses in the north for 200 grand or 6 for 100 grand if you want to keep investing in property. So look at it that way as well, right? Now, the rental pyramid looks nearly opposite, but not quite. So below the average for England, the southeast still up 7% in rents. West Mids at 6.9, Southwest at 5.4, Yorkshire at 4.6, which looks relatively affordable. Now, London isn't top of the rental increase index for the first time in a while, but it is second at 9.1% year on year, and the Northeast hit 9.4. The Northwest isn't far behind at 9%. So the North is racing forward in rents and house prices. All looks very strong apart from Yorkshire, which presumably has either got enough social housing generally or some larger private landlords not selling off in volume. But I think that's probably one for another supplement if I wanted to analyse Yorkshire in detail. Or someone listening might know the answer to that. And if they want to leave a note about that, that'd be lovely. I'd love to read about it and hear about it. So the madness on rent subsidising at a reasonable pace, it seems, just as the owner-occupier housing figure subsidised a bit, it subsided a bit in this month's inflation report, which I referred to last week. So yields are still climbing, and with recent figures from other areas suggesting prices have stabilised a bit, I still expect that yield expansion to continue throughout 2025 as far as resi is concerned. So let's see how guilty we should all feel after the Easter chocolate. That is a horrible gag, but I'm not sorry. The answer is not that much, happily. The second short week in a row with thinner volume, so beware drawing too many conclusions, but also the week where the cut for May in the base rate really got nailed on, saw the gilt open at 4.046% yield on the 5-year, and then it closed at 3.975. So closes below the 4% yield on the 5-year gilt have been few and far between for some time. It's been over 6 months, and that was only a brief hiatus under 4% anyway. So enjoy it while it lasts. Again, is it an event horizon? No, but it's good to see nonetheless. The SONIA swap closed Thursday at 3.641, one of the lowest prints for a long time, compared to over 4% 1 month ago and over 4% 12 months ago. A real rarity, so happy days. Now, interest rates could be very wobbly over the next few months, depending on what happens in the US. So I wouldn't hesitate before taking prices from lenders and then checking whether existing mortgage applications have rates that can be brought downwards or not. So this compares to a 3.995% close on the 5-year gilt yield. So we're still getting about a 35 basis point discount on the SONIA swap for 5-year debt. The demand for 5-year debt is still not sufficient enough to drive that swap discount downwards, or shrink the discount, I should say. Now, the yield curve is finally starting to look orderly again. The 3-year gilt looks particularly reasonably priced at this point in time. But beware, because you might remember we've had an inverted curve for a couple of years now, right? But it could have been a false signal of a recession this time out. One of the big reasons for that inverted curve was arguably the central banks, Bank of England, setting the rate too high in a risk management play. And there is an argument that the rate shouldn't have gone above about 4.5% at any stage, and they didn't really add any value by going up to 5.25. But go up they did, manage risk they did, and you can't, just because one particular scenario played out doesn't self-evidently mean they made a huge mistake. So we do need to bear that in mind, right? Now, remember, when you have an inverted yield curve, usually it starts to normalize just before a recession. And I've said earlier on, we printed 48.9 on the services PMI. Now, I'm not in the recession camp yet, and I'm always critical of those who predict 10 of the last 0 recessions, and then they miss it when there is a recession. Always say the same thing on that front, and don't worry about things on a 1 monthly basis unless there's a look. If Lehman folds, yeah, we need to make decisions in the now. Don't get me wrong, right? But it's not, we're not at event horizon sort of territory, right? The 3-year swap is not trading much below the 5-year, so it's all about supply and demand. You don't see tons of 3-year fixed products, do you? But they are out there, and if they work for you, you can look. But you could see some 5.65% products out there fairly soon. Limited company, no fee. Be perfectly legitimate to see them. Will they wait until the week of the Bank of England meeting, after the Bank of England meeting? Very possibly, right? So bear in mind. So onto the gap anyway in the deep dive. And I'm not talking about the retailer that has gone online only or is serviced by Next shops these days. I'm talking about that gap between forecasts and reality. And I've made plenty of noise about this. How do we get into the last week of a quarter, let alone a fiscal year, and still produce a terrible forecast? It really shouldn't happen. It's enough to make people like Sasha, who I mentioned in the intro, very suspicious. I don't blame him, but I don't live in the conspiracy camp. I think primarily it's a cross of laziness and incompetence. I don't think we have the best economists in the world in those positions in the public sector. No one holds them to account. They're never told off for making bad forecasts. And in fact, everybody just says, well, as soon as you made a forecast, it's wrong anyway. I really dislike that attitude as a general rule. I think you should just try and do the best job you can every time. And I think you should defend why the forecast changed. And then when something changes, of course, your forecast changes. When the facts change, I change my mind, sir. What do you do? The famous quote, right? So this is why we've got to take a look at these, because the report that came out on the 26th of March that then has led to these figures, this report's been released this week by the OBR, that comments on the March forecast versus the reality. And it just reads like a complete embarrassment, which is why we need to look at it. The Office for Budget Responsibility then, quite quiet mostly, with an unholy amount of influence over the Treasury and the Chancellor. When they do speak, I normally get disappointed, and this week has been no different. Their forecasts are so poor that we need to distinguish between poor but difficult and poor but inexcusable, I think. Their commentary on the public finances March 2025 was released on the 23rd of April. Now, firstly, we do have to be fair. This is an initial estimate. But as I said earlier on, I've noticed that almost every month without fail, the actual amount we're borrowing has been exceeding the forecasts, sometimes by a bit, sometimes by a lot. Even a bit is a lot in absolute terms, of course, because we're talking hundreds of millions by a bit. But I mean in terms of percentages, because we have to put it into context, right? So how much did the public sector borrow net in 24-25? £151.9 billion, 20.7 billion more than the previous year, 14.6 billion above their March forecast. Yes, that's right. As I said, even if we're very fair and say that was finished in late January, early February, they were still 14.6 billion out, or they were 10.6% out on the amount of money that they borrowed the wrong way. And 10.6 does look ridiculous with a couple of months to go, doesn't it? It's absolutely inexcusable and laughable, in my opinion, right? They don't sugarcoat it. They say it's largely explained by lower than forecast receipts. They collected less tax than they thought they would. Now, if you're seduced by the millions of millionaires leaving the UK, now remember the context, we're told that 10 to 12,000 have left, and there are around 2.5 to 3 million millionaires in the UK. You may not realise that. That is not a typo or a misspeak. 2.5 to 3 million. There are more than $3 million millionaires in the UK, right? And those telling us everyone's leaving are also happily those who are providing advice to those who want to relocate offshore. So it's nothing short of marketing, to be honest with you, in my opinion. Propenomix doesn't work like that, as you know. I look at the details and then I talk about conclusions we really might be able to draw in the cold light of day, right? Central government did need £7.9 billion more than the March 2025 forecast, which is not a small number, and it's unlikely to be revised much, normally fairly accurate. Why they've got that so far wrong is a bit worrying, isn't it? So the OBR can't tell with a couple of months to go, or 17% of the fiscal year left, that central government is going to overspend by the thick end of £8 billion. What sort of control have they got on this beast, And then receipts were 7.8 billion below forecast. So it almost split the difference in half, right? Almost exactly equivalent to the overspend, which is a strange coincidence. But those two numbers together don't add up to the gap, because we have to consider local authorities, we have to consider public corporations, but they're not a bad proxy for the problem, and they're certainly the vast majority of the numbers, right? So how did this break down? HMRC cash receipts were 2.5 billion below forecast. Now, that was primarily PAYE and national insurance contributions, 1.6 billion less than forecasted. They blame weaker than expected growth in bonuses, particularly in the financial sector. Now, I'm not seeing this. They had pay growth pegged well below where it got to in the 24-25 financial year. Well, then perhaps they'd adjusted that by the March 2020, by the March forecast that they did. But it does sound like a large shortfall. I'd certainly interpret that as they lost more jobs than they thought they would in March. But they do say this bit can be revised because many bonuses are paid in March with the tax on them paid in April. So let's see. I think maybe when Labour changed the rules on banking bonuses and things, they thought would have an immediate impact, whereas perhaps the likelihood is it takes a couple of years to kick back in. I don't know. I don't work in banking. If anybody does and wants to leave a comment, then I'd appreciate it. Self-assessed income tax and capital gains receipts, £1 billion short. Now, this was on top of a revision of £5.9 billion downwards in the March 2025 forecast. Less was paid. Behavioural response to tax policy changes, weaker self-assessment returns. Is that just because of inflation and rising interest rates in the year, which wasn't captured adequately in the forecast? is it just tough business conditions that hasn't been taken into account? Could well easily be the last one, because we've seen a very flat economic performance since about May of 2024, realistically. Now, that was largely as per the forecast, as was corporation tax. And then there's a little bit of a footnote about £3.3 billion, which of course passes the buck to somebody else, naturally. So part of the reason that borrowing in the year to February has been revised upwards by 3.3 compared to the ONS's previous estimate, blame the ONS, onshore corporation tax 2.1 billion lower than originally estimated. Income tax 1.9 billion lower. National insurance contributions actually up 900 million. I'm glad we're on top of all of that. So is this a new 14.6 billion black hole since the spring statement? Yes. Yes, it is, sadly. But hopefully outturn data will improve the forecast element. But it isn't like they count everything up until the end of March. They've also forecasted what they should collect during April and beyond that should be accrued in last fiscal year. So let's dwell on the other parts that aren't just me lamenting how terrible our forecasting is at the top level in the UK. Public sector net borrowing on these numbers was up 15.78% year on year. That, of course, is unsustainable. But what's the moral of the story at a more strategic level? Well, we need the interest rates to come down and inflation to continue doing its thing to devalue this nominal debt. Trump has figured this out. And the answer to his inevitable question, well, how do we get the rates down, has, they hope, been answered by Liberation Day. However, when the bond yield started to climb, he had to climb down. It's not so much will he go again, but when will he? We are takers in this situation, and arguably we're relatively better off, although we're absolutely poorer from the tariff situation. I'm saying relatively compared to other countries. We might just be a beneficiary of being a better investment destination, depending on just how Trump tries to solve this one, right? Now, I hope all that was a bit of interest and it was useful. Hopefully you can see where I'm coming from and my thoughts on what's going to happen over the coming months. I don't see any sort of major icebergs coming. I see more treacle, as I've been predicting and talking about for some years now. If you don't already subscribe to the channel on YouTube, I'd very much appreciate you doing so. Propenomix with Adam Lawrence, liking the videos, leaving comments. I do try to reply to all the comments. I hope today was of interest. I hope it was useful. Lamenting our forecasting as a national embarrassment once again, but it's also a reminder of why I do my own forecasting. And you can stay up to date with the channel and the live videos on property and poppadoms, so you can see what I'm thinking and what's going on. And so as I wrap up, just a reminder to book those tickets for Thursday, the 3rd of July for my next property business workshop with Rod, joint ventures, mergers and acquisitions. We will guarantee you another fabulous day of learning and discussion. Super early bird tickets, genuine 20+% discounts are available. No trickery on any of those at the link that's in the description, bit.ly/PBWSEVEN. But above all, please make sure, keep calm, always listen to the supplement and carry on, because there's going to be opportunities abound this year and towards 2030. And the risks at this time, whilst the geopolitical ones feel significant, are far less meaningful to the UK housing market than they have been for several years. Of that, I have no doubt. We have a runway of growth ahead of us that's going to be difficult to knock off, and property will remain the best asset class, major asset class, and the safest asset class that your money can be invested in my opinion. So keep calm and carry on, folks. Thank you for tuning in. All the best.